Hey everyone, and welcome to Talk Tickers, where we break down the earnings calls that are really moving the markets. Today, we are tearing into the homebuilder Lennar's fourth quarter 2025 report. Now, they reported after the bell, and let's just say the market's first impression was not great. So let's get right into it and figure out why.
Okay, so right off the bat, you can see the conflict. On one hand, you've got revenue coming in at $9.37 billion. That's a beat of almost 4%. Pretty solid, right? But nobody cared. Why? Because everyone was looking at the other side of the screen, GAAP earnings per share of $1.93. That was a huge 13% miss. And that disconnect, well, that's what set the entire tone for this stock.
And the market's verdict? It was fast, and it was brutal. The stock got hammered in after-hours trading and ended up closing the next day down over 4.5%. Investors sent a really clear message. We don't care about your revenue beat when there are bigger problems under the hood. So what was that big problem? What drove this super negative reaction? Well, it all boils down to one thing, and it's a big one: profitability. Their margins didn't just shrink, they absolutely collapsed, and that just stole the show. And I mean, this chart tells you everything you need to know. A year ago, Lennar's home sales gross margin was a healthy 22.1%. This quarter, it plummeted to just 17%. That is a 510 basis point drop. For a homebuilder, that is a massive, massive red flag, and it was the central issue in this entire report. So what caused the free fall? Well, management was actually very direct about it. They said that in order to keep houses selling in this really tough, high-interest rate environment, they had to crank up incentives and price cuts to about 14% of a home's value. Now, just to put that into perspective for you, in a normal, healthy market, that number should be somewhere around 4 to 6%. So yeah, 14 is huge. And to their credit, they didn't really try to hide it. The executive chairman, Stuart Miller, basically laid it all out. He said, and I'm quoting here, that sales volume has been difficult to maintain and required additional incentives. So you see, this was a conscious decision, a strategic trade-off. They chose to sacrifice their profitability today to keep the sales engine running and, crucially, to avoid getting stuck with a massive pile of unsold houses. Okay, so that's the problem. But what's management's story? How are they spinning this? Well, despite all that margin pain, they spent most of the earnings call trying to convince investors that they're playing the long game. The argument is that they're building a leaner, meaner home-building machine that's going to be perfectly positioned when the market finally turns around.
And here's what that strategy looks like. Step 1. Keep building houses no matter what, just to keep the assembly line moving. Step 2. Use those incentives and lower prices to steal market share from smaller, weaker builders who can't afford to compete. Step 3. Use that consistent volume to negotiate better prices on materials and labor, driving down their own costs. And step 4, the big payoff. Be ready to capture an explosion in margins the second the housing market recovers.
And you know what? They brought some data to back this story up. They're saying, hey, forget the financial margins for a second and look at our operational engine. New orders are up a solid 18% year over year. They're turning over their inventory way faster. It's taking them just 127 days to build a house now, and their construction costs are actually down about 10% from a couple of years ago. So the factory itself is running better than ever.
But here's the catch. The stock market doesn't really care about what you did yesterday. It cares about what you're gonna do tomorrow. And when it came to their guidance for the first quarter of 2026, well, it did absolutely nothing to calm anyone's nerves. In fact, it kind of confirmed that the pain is going to continue.
Just take a look at the Q1 guide. Deliveries, sales price, it's all pretty much as expected. But then you get to that gross margin line I've highlighted. They're guiding to just 15 to 16%. That's another step down from the 17% we just saw in Q4. Management literally said they hope this will be the low point of the year, which tells you the bleeding hasn't stopped yet. And looking out for the whole year, for all of fiscal 2026, they're guiding to about 85,000 home deliveries. Now that's only about 3% growth over the previous year. It's not exactly an inspiring number, is it? It basically signals that management is buckling in for a long, tough year. All right, so let's put it all together. You've heard the good, the bad, and the ugly. It is time for the next call, where we sort through the noise and give you our official take on Lennar stock. So this really gets to the heart of the debate for any investor looking at this company. You've got this super efficient, humming operational machine on one side, but on the other, you have these just awful margins. So where does the stock go from here? Does the market start looking past the short-term pain to the long-term potential, or does it stay stuck on the here and now? The bull case is pretty simple, right? Management is building this incredible platform. The moment the market turns and those crazy 14% incentives fall back to a normal 4 or 6%, that difference, that 800 to 1,000 basis points of margin, goes straight to the bottom line. That's massive operating leverage. But the bears are looking at the exact same situation and saying, hold on, the affordability crisis isn't going away overnight. The consumer is weak. Those high incentives could be here for a long, long time, which means those ugly margins and that boring 3% growth is the real story.
So, where do we land? At the end of the day, our rating on Lennar is market perform. Look, the operational improvements they've made are real and they're genuinely impressive. But the outlook for margins in the near term is just too ugly to ignore. It feels like the stock is pretty fairly priced right now, balancing that long-term promise with some very real short-term pain.
All right, and before we go, it's time for our wild but plausible trade idea. Management mentioned over and over again on the call that a big government program to help housing affordability could be a huge catalyst. So if you're an investor who believes that's a key theme for 2026, here's an idea. Instead of just buying the stock and waiting, you might consider long-dated call options. This isn't about betting the stock will slowly grind higher. It's a specific play on a volatility spike if and when a big policy announcement actually happens.
And as always, please remember, this is not financial advice.